There's a fleet of aging oil tankers, many over 15 years old, with unclear ownership and dubious insurance, moving millions of barrels of Russian crude across the Indian Ocean every month. Western shipping companies won't touch them. Legitimate insurers won't cover them. These vessels operate in a gray zone of international maritime law, often turning off their transponders to avoid tracking, sometimes transferring cargo ship to ship in the middle of the ocean. This is not smuggling in the traditional sense. This is how Russia moves its most important export in 2026, the shadow fleet, and it is keeping the Russian war economy alive. Before the war, Russian oil moved through established channels on modern tankers with proper insurance and transparent ownership. That system is gone. Now Russia's economic survival depends on ships that Western maritime lawyers describe as floating liability time bombs. One major spill, one insurance dispute, one coordinated legal seizure, and the entire system could fracture. The absurdity is this: Russia has $750 billion in international reserves. It has a national wealth fund with another $170 billion in liquid assets. Its public debt is around 15% of GDP, one of the lowest ratios in the world. On paper, Russia looks financially secure, almost invulnerable. And yet, this supposedly secure economy is dependent on aging tankers with fake insurance to move the energy exports that fund everything. The sophisticated reserve management coexists with a shipping operation that operates in legal gray zones. The financial fortress is built on a foundation of discounted oil moved by ships that turn off their tracking systems. So what is actually happening here? How does an economy with enormous financial buffers end up relying on a shadow fleet? How is Russia actually paying for the most expensive military conflict in Europe since World War II? Where does the money come from, and how long can the system hold together before the contradictions tear it apart? This is the money timeline. Today, we're going to examine Russia's war economy in January 2026. We'll look at the current state of growth, inflation, and employment, and why the picture is neither collapse nor stability. We'll examine where Russia actually makes its money now that Europe is gone as a customer. We'll break down how the Kremlin finances the war through energy revenues, domestic borrowing, budget reallocation, and off-budget mechanisms that hide the true cost. We'll analyze what those massive reserve buffers actually mean in practice and why they're less useful than they appear. And we'll assess how long Russia can sustain this model before structural damage becomes irreversible. This is not about politics or military strategy. This is about the economics of financing a war when you're cut off from half the global economy and forced to rebuild your entire export system using ships that most of the world won't insure. When Russia launched its full-scale invasion of Ukraine in February 2022, Western governments predicted economic collapse. Sanctions would cripple the Russian financial system. Energy embargoes would drain revenues. The ruble would crash. The economy would contract violently. Russia would be forced to capitulate due to economic pressure. That did not happen. The ruble stabilized. Energy revenues continued flowing, albeit through different routes. The economy contracted in 2022, but less than many forecasts predicted. By 2023, Russia posted modest growth. Western analysts began revising their predictions. But by January 2026, the picture is neither collapse nor stability. It is stagnation with structural rot. The International Monetary Fund's January 2026 projections show real GDP growth for Russia at around 0.6%, essentially zero. Other multilateral forecasts are similar. Growth is flat, investment is subdued, the economy is not expanding in any meaningful way. Inflation remains elevated. Consumer prices are rising faster than the central bank would like, driven by defense spending, supply chain disruptions, and labor shortages. The Central Bank of Russia has kept interest rates high to control inflation, but this also suppresses private sector borrowing and investment. It is a policy trade-off with no good options. Official unemployment is low. This sounds positive until you look beneath the surface. Unemployment is low because the labor force is shrinking. Hundreds of thousands of working-age men have been mobilized for the military. Hundreds of thousands more fled the country to avoid conscription. Demographic trends were already poor before the war, with an aging population and low birth rates. The war accelerated the decline. The result is an economy that is running hotter than it should be, not because of productivity growth or investment, but because there are fewer people available to work. Wages are rising, not due to improved efficiency, but due to labor scarcity. This creates inflation without corresponding increases in output. It is the economics of a wartime mobilization economy, not a healthy market system. Capital flight was significant in the early months of the war. Foreign investors pulled out. Domestic wealth holders moved money abroad where possible. While this has slowed, the underlying trend is clear. Confidence in the long-term stability of the Russian economy is weak. Investment goods are restricted by sanctions. Productivity is stagnant. The economy is not building a foundation for future growth. It is consuming existing capacity to fund immediate military needs. In short, Russia's economy is not collapsing, but it is not functioning normally either. It is grinding forward at near zero growth, sustained by large financial buffers and continued energy exports, while slowly accumulating structural damage that will take years to reverse. Russia is a resource economy. It always has been, and the war has made it more so. Fossil fuels dominate. Crude oil, refined petroleum products, and natural gas remain the largest source of export earnings and a massive share of federal revenues. Taxes on oil and gas producers, export duties, and associated corporate receipts fund the Russian state. Without energy revenues, the government budget collapses. Before the war, Europe was Russia's primary energy market. Russian natural gas heated European homes, Russian oil fueled European industry. Russian pipeline infrastructure was deeply integrated with European energy systems. That is over. Since 2022, Russia has redirected the vast majority of its crude oil and refined product flows away from Western Europe and toward Asia, South Asia, Turkey, and the Middle East. China and India now account for the lion's share of seaborne Russian crude. Turkey is a major buyer of refined products. Some European imports continue in special cases, but the volumes are a fraction of pre-war levels. These sales happen at significant discounts. Russia does not have the leverage to demand full market prices. Buyers know Russia has limited alternatives. Sanctions and Western embargoes have reduced the number of willing purchasers. So Russia accepts lower prices to preserve volumes and maintain cash flow. Independent estimates suggest Russian crude sells at a notable discount to global benchmarks like Brent. This discounting is not trivial. It represents billions of dollars in lost revenue annually. Russia is selling the same physical barrels of oil, but for less money. That difference goes straight into the pockets of Chinese and Indian refiners, who then sell refined products at global market prices. Russia subsidizes its customers to keep the system functioning. The logistics of these sales have also become more complex and expensive. Russia relies on what is known as a shadow fleet of aging tankers, often with unclear ownership and insurance, to move oil to Asia. Western insurance and shipping companies have largely withdrawn from the Russian market due to sanctions risk. The ships that remain are older, less efficient, and more expensive to operate. This adds costs and risks to every shipment. Beyond oil, Russia exports metals. Aluminum, nickel, palladium, and coal generate foreign currency. Agricultural commodities, particularly grain, also contribute. But these are far smaller revenue sources than energy, and many of them face sanctions or export restrictions that reduce profitability. Services and high-value manufacturing, which were growing sectors before the war, have largely collapsed. Western investors left. Technology companies pulled out. The domestic tech sector lost access to global supply chains and capital markets. Russia is more dependent on raw material exports now than it was before the war. This is the opposite of economic development. It is regression. The bottom line is clear. Russia makes money by selling oil and gas, mostly to Asia, at discounted prices. That revenue funds the state. Everything else is secondary. The European Union has introduced 15 sanctions packages against Russia as of January 2026. 15. Let that sink in. 15 separate rounds of coordinated restrictions, embargoes, asset freezes, and export controls. Each one negotiated, debated, and implemented with great fanfare. Each one described as a decisive step that would cripple the Russian war machine. And yet, Russia is still fighting. The economy is still functioning. Energy exports are still flowing. The ruble is still stable. The government is still financing the war. This is not to say sanctions have had no effect. They have. But the effect is not what was promised. Sanctions have not caused immediate economic collapse. They have not forced a Russian retreat. They have not stopped the war. What they have done is change how the Russian economy operates and impose long-term structural costs. The most effective sanctions have been on technology, advanced machinery, and financial channels. Russia can no longer easily access high-end semiconductors, precision equipment, complex industrial machinery, or Western financial services. These restrictions matter because Russia cannot produce many of these goods domestically. Import substitution efforts have produced some results, but they do not fully replace what was lost. Western capital has disappeared, foreign direct investment has collapsed, joint ventures have been dissolved, technology transfer has stopped. This will reduce productivity and innovation over time, but the effects are slow to appear in headline GDP. They show up years later as reduced competitiveness, outdated equipment, and lower growth potential. Energy embargoes have been less effective than intended. The EU banned Russian crude oil and refined products, but Russia simply redirected those flows to other buyers. The price cap imposed by the G7 was meant to limit Russian revenues, but enforcement is difficult, and Russia has found ways around it through the shadow fleet and creative invoicing. The fundamental problem with sanctions is that they work slowly. They impose costs, reduce efficiency, and limit options. But they do not create immediate crises. Russia has adapted, trade routes have shifted, payment systems have adjusted, companies have found workarounds. The result is a less efficient, less profitable, and less dynamic economy, but not a collapsed one. The 15 EU sanctions packages reflect the political difficulty of coordinating action among 27 member states with different economic interests. Some countries are heavily dependent on Russian energy. Others have significant trade relationships. Every package required compromise, which diluted effectiveness. The incremental approach gave Russia time to adapt, find alternative buyers, and build workarounds. Sanctions are working, but not in the way they were sold. They are not a quick fix. They are a slow squeeze. The damage is cumulative, not immediate, and Russia has proven more resilient than Western policymakers expected. Russia is not financing the war through traditional wartime measures like mass bond drives, hyperinflation, or printing money. It is using a combination of energy revenues, domestic borrowing, budget reallocation, tax increases, and off-budget financing. The system is more complex and less transparent than it appears. First, energy revenues. Oil and gas receipts provide the largest portion of convertible currency available to the state and state-owned companies. Even at discounted prices, these revenues are enormous. They fund routine budget items and are fungible for defense purposes. The government does not need to explicitly allocate oil revenue to the military. Money is money. Energy earnings flow into the general budget, and the budget prioritizes defense spending. Second, budget reallocation. The 2026 federal budget allocates an unusually large share of spending to defense and security. Independent analyses suggest defense and security spending now represent a massive portion of total federal outlays, far higher than pre-war levels. This comes at the expense of other priorities. Infrastructure, healthcare, education, and social programs receive less funding. The government is prioritizing war over everything else. Third, domestic borrowing. Russia has issued government bonds to domestic buyers to cover budget shortfalls. This works because Russia's public debt ratio is low, around 15 to 20% of GDP. Domestic savings still fund government paper. Banks, pension funds, and other institutional investors buy Russian government bonds. This is sustainable as long as debt levels remain manageable and inflation does not spiral out of control. But relying on domestic credit markets means the government is crowding out private sector borrowing, which reduces investment and long-term growth. Fourth, tax increases. The government has implemented higher VAT and other tax measures to increase revenues. These changes extract more money from the economy to fund the war, but they also reduce consumer spending and business profits. It is another trade-off with long-term costs. Fifth, off-budget mechanisms. This is where it gets murky. Beyond the formal budget, funds flow through state corporations, defense industry budgets, regional transfers, and Russian banks connected to defense suppliers. Oligarchic networks and state enterprises mobilize capital outside public reporting. Some funding is effectively hidden inside state procurement vehicles. Public reporting is limited, which makes it difficult to know the true scale of war-related spending. Russia also benefits from its national wealth fund and massive central bank reserves. The NWF held roughly $175 billion in liquid assets at the end of 2025. International reserves were around $750 billion. These buffers allow the government to smooth shocks and finance deficits without immediately resorting to money printing or external borrowing. The reserves act as a financial cushion that buys time. The system works because Russia has large buffers, low public debt, and continued energy revenues. But it is not indefinitely sustainable. The more the government relies on domestic borrowing, the higher borrowing costs rise. The more it raises taxes, the more it suppresses private sector activity. The more it diverts resources to defense, the less it invests in future productive capacity. Each of these mechanisms works in the short term, but imposes costs that accumulate over time. Russia entered the war with unusually large financial buffers. As of January 2026, international reserves stand at roughly $740 to $760 billion. The National Wealth Fund holds another $160 to $175 billion in liquid assets. Public debt is around 15% of GDP, one of the lowest ratios among major economies. External debt is modest, reported around $300 to $320 billion in 2025. These numbers look impressive on paper, and they are real. Russia has the financial capacity to absorb shocks, cover deficits, and sustain elevated spending for a significant period. This is why predictions of imminent economic collapse have been wrong. The buffers are large enough to prevent a near-term fiscal crisis. But there are practical limits to how these buffers can be used. First, sanctions constrain access. A significant portion of Russia's foreign reserves are frozen or immobilized by Western authorities. Russia cannot freely liquidate or transfer these assets. Estimates vary, but hundreds of billions of dollars in reserves are effectively inaccessible. This reduces the usable buffer. Second, political and legal risks exist. The European Union and other Western countries have discussed using frozen Russian assets to fund Ukraine's reconstruction or provide direct financial support. If this happens, Russia loses access to those assets permanently. This introduces uncertainty about the true size of available reserves. Third, using reserves has domestic costs. Drawing down the national wealth fund or selling foreign assets under sanctions is complex and politically sensitive. It signals financial stress, which can undermine confidence. The government has been cautious about tapping these funds aggressively. Fourth, low public debt gives Russia room to borrow more domestically, but that capacity is not infinite. Domestic credit markets can only absorb so much government debt before yields rise and crowding out accelerates. The more Russia borrows domestically, the higher the cost of servicing that debt, and the less capital is available for private investment. Fifth, external financing is largely cut off. Sanctions have closed most normal sources of external borrowing. Foreign capital inflows are episodic and often come from allies like China, which may attach political or economic conditions. Russia cannot easily access global capital markets the way it could before the war. The buffers are real, but they are not a magic solution. They provide time, not an unlimited runway, and the more Russia relies on them, the more it depletes resources that could otherwise support long-term growth. Reserves can cover deficits for years, but they do not generate growth, rebuild infrastructure, or attract investment. They are a cushion, not a cure. Or the question is not whether Russia can finance the war tomorrow. It clearly can. The question is how long the system can function before structural damage becomes unsustainable. In the short to medium term, measured in months to 1 or 2 years, Russia has the capacity to continue. Large reserves, functioning energy exports, and low public debt provide a cushion. The government can increase domestic borrowing, raise taxes, and draw modestly on the national wealth fund. Immediate sovereign default is not the risk. In the medium term, 2 to 5 years, the pressures intensify. Sustained discounting of energy exports shrinks fiscal windfalls. Tighter global secondary sanctions or de-risking by key buyers could cut volumes and prices. The cumulative loss of Western investment and technology depresses non-energy export capacity. Demographic and labor shortages raise costs. If one or more of these factors intensifies, fiscal buffers will be drawn down faster. Domestic borrowing costs will rise, and the government will face hard choices. Deeper austerity, steeper tax hikes, or greater reliance on off-budget financing all reduce growth potential and social stability. Analysts and official forecasts from the IMF and World Bank already model near zero growth and rising structural scarring. This is consistent with an economy that deteriorates visibly over a multi-year horizon. The effects are slow, but they compound. Reduced investment today means lower productivity tomorrow. Lower productivity means weaker revenues and less capacity to fund the state. The cycle reinforces itself. Tail risks exist. A sharp global oil price shock downward would cut revenues dramatically. A coordinated cutoff of buyers under stronger secondary sanctions would eliminate major revenue sources. The confiscation or use of frozen assets by Western powers would shrink available buffers and signal permanent financial isolation. Any of these events would materially shorten Russia's runway and force emergency measures. Large drawdowns of the national wealth fund, painful domestic retrenchment, or inflationary money printing would become necessary. Conversely, sustained high oil prices and continued purchases by non-Western buyers would extend the timeline. If China and India keep buying at current volumes, and if global energy prices remain elevated, Russia can finance the war for longer. The system can limp along, stagnant and inefficient, but functional. The practical limits are not just financial, they are also structural and political. Even with large reserves, Russia cannot easily replace lost Western technology, managerial expertise, and capital. Import substitution has limits. Trade with non-Western partners does not fully replace what was lost. Over time, outdated equipment, declining productivity, and shrinking investment reduce the economy's ability to generate revenue. The state becomes dependent on a narrower base of resource exports, which makes it more vulnerable to commodity price swings. The long-term trajectory is clear. Russia's economy is not collapsing, but it is stagnating and accumulating structural damage that will take decades to repair. The buffers provide time, but they do not solve the underlying problems. The war is being financed through a combination of energy revenues, domestic borrowing, and deferred investment. That works for now, but it creates a future where growth is lower, options are fewer, and the economy is more fragile. The question is not if the model becomes unsustainable. It is when. Russia's war economy is functioning. That is the headline. The state is still financing massive military spending. Energy exports are still flowing. The ruble is stable. Reserves are large. Public debt is low. The system has not collapsed, but functioning is not the same as thriving. Russia's economy is stagnating. Growth is near zero. Investment is weak. Technology and capital have been lost. Trade routes are less efficient. Energy revenues are discounted. The labor force is shrinking. Structural damage is accumulating. The buffers are real, but they are being consumed. Reserves cover deficits today, but they do not generate future growth. Domestic borrowing works now, but it crowds out private investment. Energy revenues sustain the state, but they are lower than before the war and dependent on buyers who extract discounts. The 15 EU sanctions packages have not caused immediate collapse, but they have imposed long-term costs that compound over time. Russia can finance the war for years, not weeks, but the clock is ticking. The longer the war continues, the deeper the structural damage and the harder it will be to reverse. The war economy has an expiration date. The only question is when it arrives. Thanks for watching the Money Timeline.